It's Thursday, the 2nd of February, so let's take a recap firstly of what the Fed said last night, if you've not caught up with that quite yet. We'll have a look about the statement which they released, so just very subtle changes, and then we'll look through some of the news flow that's come out overnight, and then corresponding any impact that this can have on the charts we're looking at and the assets we're monitoring this morning. So just looking more broadly across the charts, though, you can see Eurodollar and cable both on the front foot this morning, so in positive territory. That comes amid the dollar index. Actually, the dollar index is sitting just around the lows that were seen yesterday. So maybe worth just monitoring that if it starts to see some another concerted move to the downside, technically breaking that low. Obviously, we're well below 100 now in the Dixie, and we're down around 0.3% there. So hence both pairs seeing a bit of support this morning. Just looking at cable more short term, you can see that high that was kind of seen yesterday evening, and then also overnight. We've just broken through that more recently as Europe's come in. Likewise, upside in the Eurodollar. We're keeping an eye on similar type levels. Upside, you've got R1, and then just a few pips above there, the high print from yesterday afternoon as well. So a couple levels upside just coming up in the currencies to keep an eye. Having a look at cable in a bit more detail. This was obviously some big levels we've been looking at more recently, and really this kind of defines the range, if you like, that we've traded through much of the beginning of 2017. You had that brief kind of look above that 24.31, which has been ultimately key through the middle of the month of January. We broke that, it came back for support before a strong move higher, and then again this was only 2 days ago when it tested that level and again saw another strong bounce to the upside. The difference here though is that earlier high that we printed back on the 26th, that was what contained the price action yesterday evening, that level, but as we've come in, we've managed to just squeeze above that. Now there's a couple of news items which might explain this, and we'll look at that in more detail, but essentially more Trump kind of having politically tough conversations, this time with Australia overnight. So the dollar's a little weaker again in the context of the bill going through in the House of Commons with no real issue last night. So that could be seen as a sterling positive in terms of clarity, at least, that the government is still following their predefined timeline. So cable just squeezing above that high print, technically significant now. And if we go a bit more longer dated, looking at a daily continuation chart, you just remove some of these. And actually you can see that level around here where we've just broken above, it kind of opens up now. That 128 is the really key level, and that's one I've been pointing out before. I've always thought that given the context at the moment, especially with the inflation angle and with the timeline not until triggering Article 50 till the end of March, is that actually I think inflation is kind of more of a near-term potential focus, and 128 is the kind of target that I'm looking at. But then to break that, I think that will be a solid level of resistance, that being the high that we saw back in the end of last year in December. But ultimately that was the post-Brexit low, and that triggering that really contributed to an aggressive move downward at the beginning of October of last year. So definitely I think 128, not saying specifically today, but I think there's still room until we get to that point. Then I think technically it gets a bit more tougher to move further to the upside. But obviously we'll be monitoring the news in the interim period to keep an eye on that. But okay, let's have a look at the US assets for a second. Let me just hover my cursor over the period, or let me just highlight it for you on these charts. This was the FOMC statement. And I've got the T note in the bottom corner. So the two circles I've just highlighted here are basically the S&P reaction to the FOMC statement and the T note reaction. So one of the things that you'll get better, the newer guys, as you kind of interpret news, is even without the first thing I do in the morning when I turn on my screens is I can pretty much tell what the news is by how the charts are presented. Now, what I can see here is a fairly whipsaw price action in the S&P, but overall this is very small reaction, and ultimately we saw out the rest of the US session without much fuss, if you like. Whereas in the yields, I can see yields fell after the statement, and we had a gradual rise all the way up to the Treasury pit close. So there must have been some sort of slight dovish tinge to how the market interpreted the FOMC statement, but as was largely expected, probably nothing too great, because these moves were only talking 7 to 8 ticks in the Treasuries, or in the T-note, which isn't massive by any stretch of the imagination. So let's have a quick recap. So the main headline being that the Fed nods to improve sentiment, but they leave rates unchanged. Policymakers reiterated outlook for moderate economic growth. That's kind of the headlines. Now, if I look at this in a bit more detail, this is that Fed tracker that I always suggest that you guys use when you're monitoring Fed statements. If you just basically Google search WSJ Fed tracker or Fed statement tracker, that takes you to the Wall Street Journal's page. And what this does then is it takes the two selected statements to put them side by side in comparison. So the previous one, December 14th, to yesterday's one, Feb 1st. And basically it strikes out where they've deleted comments and then highlights in green where they've inserted. So a couple of things here. They said economic activity has continued to expand instead of saying has been continuing. So that's broadly the same. They said a moderate pace, or expanding at a moderate pace. They said jobs gains remain solid and the unemployment rate stayed near its low, instead of saying stayed or had declined, essentially. Household spending has continued to rise moderately. Measures of consumer business sentiment have improved of late. In terms of inflation, though, that was one of the key areas that we were suggesting to keep an eye on. They said inflation increased in recent quarters, instead of saying has increased since earlier this year, but is still below the committee's 2% long-run objective. Now, they've struck out what they kept previously was that the move was partly reflecting earlier declines in energy prices and in prices of non-energy imports. So they've dropped that kind of one-off item, if you like, to explain away why it's been increasing. So that's quite interesting. And market-based inflation measures compensation remain low, though. So although they're saying that actually inflation is moving up, they've said that inflation remains low, rather than saying it has moved up considerably but remained low. So maybe you could argue that that's a little bit more on the dovish side. They said that measures of longer-term inflation expectations a little changed on balance. All of this, though, you can see really it's minimal change, if anything. And actually, one of the bigger things, I think, is just the fact that there's not really anything here to give you any greater clarity as towards any upcoming changes to policy. Obviously, if the Fed wanted to maneuver and do a rate hike in the near term, they would be giving more clarity and more direct hints rather than these subtle changes in order to signal to the market that that's their intention, and really that didn't occur, and maybe that's where some of this dovish interpretation has come from. The other interesting thing here, and something for the newer guys to be aware of, is that the Federal Open Market Committee, the FOMC, the members changed through the calendar year. And as you can see here, defined by the 10 committee members, you'll notice that George and Mester have dropped off both, both dropped off and were previously seen as being strong hawkish leaning, and so implying a more dovish Fed is now in play overall. So the composition essentially of this committee membership in terms of the regional governors rotates out with the alternate members. And what Deutsche Bank is suggesting this morning, that another interesting thing here is that maybe this slightly dovish leaning tilt to the statement has come from the fact that two of the more hawkish members have basically rotated out of the mix. So something to just be aware of. Okay, other things. This is probably another headline that you've seen, is about Theresa May. Well, the 2-day debate in the House of Commons went exactly the way that we thought and as expected. So she comfortably won the mandate to start Britain's divorce from the EU. The actual vote count was 498 to 114, a government majority of 384. So it just means then that she's got the power to invoke Article 50 and to trigger that. And so we're still looking at the end of March as that definitive timeline. A couple of interesting things, though, that did come of this from a political standpoint for Britain was that Jeremy Corbyn obviously instructed his Labour MPs to respect the Leave vote, but that's caused somewhat of havoc for the Labour Party, because dozens of pro-EU MPs are refusing to back the bill. So Dawn Butler, the Shadow Equalities Minister, and Rachel Maskell, the Shadow Environmental Secretary, these are both front bench Labour politicians, refused to obey Corbyn and voted against him. So again, just another sign what weakness at the moment Corbyn has over his own camp. The other very interesting thing here is that obviously Theresa May's come under a bit of criticism most recently about her relationship with Donald Trump, and there's one old face that popped up in the House of Commons yesterday being quite vocal when he normally is fairly silent, and that's everyone's favourite, or not so favourite, but George Osborne has almost re-emerged from the shadows, if you like, and he was very clear yesterday. He expected the negotiations with Europe to be rather bitter. He said May was not choosing to focus on the economy as a priority. He said she was too busy focusing on immigration. He said that he's spoken himself to senior figures in Berlin and Paris and has been told that they're not interested in a long and complex hybrid agreement and would prioritise holding the EU together over striking a favourable trade deal with the UK. So just quite interesting that obviously Cameron is kind of gone, if you like, out of the political scene. Osborne is still there, kind of in the background. And if you're to look at alternate candidates, if we ever got to that point, if confidence in Theresa May was questioned, and certainly, you could say this is a subtle sign of him throwing his kind of cards into the mix, potentially. And he's obviously very anti the stance of the hard Brexit line which is being issued thus far. So I thought that was quite an interesting development. To put it in a bit more context, though, when they do the vote, i.e. they walk through the lobby on these bills, you have the ayes and the noes, and obviously the ayes had it, but the noes, you can see here there was only one Conservative MP that voted against the government. So it was a resounding kind of backing, if you like. But for Labour, 47 MPs went against Jeremy Corbyn's call to arms, if you like, for them to join up with the democratic vote of doing what the people requested and following the Conservative government. Obviously, the Scottish National Party are kind of hell-bent on there being absolutely no Brexit whatsoever, so very unsurprising to see that higher number. But quite high numbers here, more actually, although I was expecting this to be a non-event. I'm quite surprised by 114 with the Labour Party contributing to these kind of alternate parties as well. Moving on, the other thing, let me just flick back to the charts for 1 second, is you can see that European equities, the DAX in the middle left here, has gapped lower, and we're trading in negative territory this morning. In sympathy then, the S&P also seems slightly lower. Now, what you've had this morning is you're now in the main heat, if you like, of UK and European earnings season. So we had Apple yesterday, and Apple certainly exceeded expectations. They actually closed up 6.1%. Apple did. Facebook last night had very good earnings, so the Nasdaq's had a pretty good time of it in the tech space. But UK and European earnings this morning have been less than impressive. Let me just run through a couple of the headlines, and it'll probably explain to you why equities are a little bit softer this morning. Royal Dutch Shell, profit misses estimates on refining production and gas units. Let me just scroll down. AstraZeneca sees an annual drop in revenues of 5% as competition from generics in the US hurt their sales of their key drug Crestor. Vodafone, one of the biggest companies in the FTSE 100, earnings to fall to the lower end of guidance. So Vodafone's third quarter results, after it said that full year earnings would be at the lower end of guidance range due to slower growth in Europe. Shell, Vodafone, Astra, these all make up part of the composition of the top 10 market-weighted companies in the UK. Then you start looking over in Europe, similar theme. Deutsche Bank misses estimates as client jitters hit trading. The CEO is cutting assets, jobs, bonuses to shore up capital. So Deutsche's trading revenue missed analyst estimates, and concerns about the company's finances weighed on clients. So overall, I'd say a negative sentiment to some of these earnings we've had this morning. And I'm just seeing flashes that Deutsche Bank shares this morning, if I flick back to here, that's Deutsche's shares this morning. They're down 6% after 1.4 billion euro Q4 loss. So definitely weakness here will explain why there's a bit of a negative sentiment materializing. Quick look back at the charts, because obviously I am aware that just as we were looking at as the briefing got underway, that dollar did break that low from yesterday, contributing to some further dollar selling. And then technically, we already said cable had broken quite a key level already this morning, and the euro just having a look now at that high print from yesterday. So definitely worth keeping an eye here, because this is technically across some of the different currencies, some key levels just being taken out. And as you can see discussed, there's been a net, I would say, short-term positive with the Brexit or triggering of Article 50 ruling. The other thing that's probably weighing as well, to a certain degree, on the dollar this morning is Donald Trump. You can't really go too many hours without hearing from the man himself, but Trump slams dumb deal with ally Australia after a testy call yesterday. Not forgetting the US has been Australia's most important ally for decades, but Donald Trump basically blasted a refugee resettlement deal with Australia in a late night tweet, and apparently had a call with senior officials in Australia and just basically put the phone down when he was in the middle of a conversation. So again, not the smoothest process of building rapport with other major politicians globally. And I would say, going off the reaction we had when he started calling people like Germany, Japan and China a currency manipulator, that created dollar selling. And you're kind of seeing that again materialize this morning. Just quickly then, to round things up, I just wanted to have a quick look at the Bank of England. Obviously today is Super Thursday. Super Thursday means you get the Bank of England decision, you get the minutes, and you get the quarterly inflation report, which has the press conference with Mark Carney as well to follow. So quite a busy session for sterling traders potentially. The thing that you'll probably realise I've been talking about a lot in the strategies that we write on a daily basis is UK inflation. Because yesterday you saw that for UK manufacturers, inflation and price pressures are at their highest in 25 years. So now starting to see the kind of delayed feed through, if you like, of the depreciation of the pound feeding through into growing inflation pressures. Now, Bloomberg this morning running their kind of preview, if you like, and they're looking at the same thing. Will rising inflation make the governor blink? And I think this is definitely an important thing to look at when we're digesting the news later at midday. So a couple of charts here to show you. This is basically painting the scene of the UK economy at the moment and what it is that we're really looking at. So this is shop till you drop, retail sales. The last figure you remember that we saw, I think it was about 2 weeks ago, fell the most since 2012 in the month of December. And remember, December is a critical month for retailers, and hence you had a profit warning from Next. Other retailers, clothing-wise and footwear, were under pressure. And that's a real negative sign, because essentially we're going into a period of political uncertainty, and you could argue that it's reflecting is a consumer base in the UK which is reticent to spend money at this point in time in an economy which we all know is heavily dependent on the service sector rather than something like manufacturing and construction, for instance. So you can see here, dramatic collapse in the last retail sales report that we had on a month-on-month change. Puts us back down to levels not really seen since we're looking at April, May of 2012. Inflation, this is the key one to look out for today. We'll look at the quarterly inflation report in more detail in an advanced preview later this morning. But essentially, the quarterly inflation report, they issue what their forecasts are for the 2-year horizon for inflation. So encapsulating in that 2-year period is critical for the markets and traders, because it means how far does the Bank of England see inflation going before it then peaks? And does it mean that it warrants that they need to take action to tame rising inflation? What you can see here is CPI in the white line, and here we are at this present point in time. The forecast is the blue dotted line, and that of course 2% is the Bank of England's target. Hence, Mark Carney, even all the way back down when inflation was at 0.5, 0.6%, he was already talking about the tolerance for inflation above target. And you can see how he uses forward guidance, if you like, to desensitize people to not get too nervous, him knowing full well several months ago that this was the inevitable truth that the weaker pound post-Brexit would have on prices in the UK. The question being, what is the trajectory of this blue line that's being forecasted? Will it go to, as they think, the high 2% region, or does it bust through 3% and not go even higher? That then becomes very problematic for them to manage from a policy point of view. Other charts, this just really defines what we were just saying about retail sales. This is Britain and the service sector. Now you can see here, construction is the kind of yellow, if you like. The other colour on the left, the sort of darker blue, is industrial production. Agriculture, look at agriculture for the UK in 2015 and 2016. It does not even appear. I was having a conversation with some of the guys here about avocados and aubergines yesterday, and about everything in my fridge is from Spain, from Egypt, from anywhere other than England. You know, when we do negotiate Brexit, this is kind of what I was trying to look forward thinking for when this does get underway, is basically, you know, when the price of these goods ultimately will go up, when we start making these new trade deals, when that starts to affect, you know, families going to their weekly shops and paying, you know, multiples more for traditional, you know, base goods that they use for feeding themselves, that's when I think you could get a bit of a political turn in the people's views and sentiment of Middle England about the repercussions of what Brexit actually has done. And so that's definitely going to be key, because we definitely are a country where agriculture is nigh on non-existent. And you could argue industrial production and construction, likewise, our whole economy is so leveraged on services. And then if I quickly flick back to what it looked like in December, on a retail sales perspective, that's looking, well, a little bit nervous going forwards. But again, this is what I would call a market view when you have to look at it between short term and long term. In the short term, right now, obviously the pound's been moving on an upward trend. And that's because I think inflation is being a dominant force for that. And people are focused on some technical moves on the upside, and that's why I think 128. But when we get to 128, given these factors of what are pointing to a slower economy through a period of political uncertainty, that's why most banks' forecasts are for ultimately cable to decline over the next kind of 6 to 12 months in a longer term play. Okay, final few charts on the Bank of England though, just to wrap things up. So this is quite an interesting one because it's the market pricing of the Bank of England rate increase in 2018. And this is looking, the white line here is today, or yesterday, the 31st, or 2 days ago I should say. Jan 19th was here, the blue line, and this purple line was where we started on the first day of the year. Look at how much this inflation angle has caught the attention of the way that the fixed income markets are priced. The probability of a rate hike in the UK by summer of 2018, at the beginning of the year, we're anticipating around 38%. We are now pricing in above 90%. Now, this is definitely the market's perception moving considerably at this point in time to factor in that no longer are we in the realms of accommodation, if you like, or extension of QE and cutting of rates, of which where we were only back in August of 2016. The game has now changed, and it's the threat of price pressures that are ultimately very important. Now, today is not just about interest rates. Let's get it straight now. They definitely are not going to be tweaking interest rates today at the Bank of England. But they do have the QE program. So first of all, the QE program was reinitiated last year. The 6-month £60 billion extension to government bond buying announced in August is set to reach its completion by the close of this month. However, absolutely none of the economists surveyed, which is approximately 50 at the major banks, are expecting any extension to quantitative easing today. So when you're hearing for the shout, that should just purely be rates on hold and then no change on the QE program. If you heard an extension to QE, anything like that, then you would see a big move in the market. You'd probably have quite an aggressive spike lower in sterling currency if they took that step as the initial knee-jerk reaction. Highly unlikely that anything QE is going to come out. Really, it's more about the projections from the QIR and the following press conference with Mark Carney. Okay, other than the Bank of England this morning, you do have to look out for UK construction PMI. Might add some very short-term volatility, but as we said, construction as an area of the PMI mix, probably the lesser important of the three, being services, manufacturing, construction. Bank of England then midday, so when that will commence. Mark Carney to speak after at 12:30. Weekly jobless numbers, and not really too much of a great deal coming out of the US in the afternoon. But there are a couple of earnings reports, I think, in the US session. The likes of Amazon's probably the biggest name, but they're after the market close. But there's 36 S&P 500 companies reporting today, so maybe just keeping an eye on the headlines and an ear on the squawk as well. Okay, guys, so overall, I would say weaker UK-European earnings, just weighing a little bit on sentiment this morning. Donald Trump talking quite aggressively with other key trade partners, this time Australia. That's probably adding to some of the nervousness as well, creating a bit of dollar weakness, giving both pairs a bit of a lift, which technically in cable has managed to surmount a key level, as well as the positive ruling in the House of Commons to just provide some clarity to the direction short term of Brexit. Gold up obviously a little bit on the back of this moderate risk off, and then in the context, Treasury still a little higher with the mildly dovish intonations coming out of the FOMC statement. So that's kind of your wrap. Enjoy your day. I will see you in the new chat room, and we'll have another more thorough briefing ahead of 12 o'clock for the BOE. Okay, guys, have a good day.